Hi everybody, and welcome to the next video on the cash flow statement. Today called the statement of cash flows. Yeah, I told you we love innovation. That's our new name for it. You see what I did there. All right, so make sure on slide 60 we're going to talk about the cash flow statements, statement of cash flows, and like the tap in the picture, you can make a profit and still go bankrupt, and that's why cash flow is so important. So that sounds a bit crazy, right? How can I make a profit on paper and still go bankrupt? And we say that's easy. Do a tender for one of the big government departments in whichever country you're in. So we had a student that won a tender from the Department of Health, delivered it, $1 million worth of office furniture. So on the income statement, profit and loss all look good. You know, you paid sales tax on the revenue, you're making profit after your cost of sales and your expenses. They paid tax on that net profit, but they didn't pay. So she'd done the order, the income statement looked rosy, but nothing on the cash flow statement, and then went bankrupt from that. So we say a sale's not a sale till the money's in the bank. It's possible to make a profit on paper and still go bankrupt. Yeah. So let's take a look at the cash flow statement. We're going to look at what we call a poor man's cash flow statement. So it's an oversimplified one for that foundational knowledge. And then if you want to look deeper, we've got the rich man's cash flow, the more complicated cash flow in the book, Understand Your Accountant, which is in the toolkit that we'll show you. So write this with me as we go. We're on the third column, the cash flow statement. We say the first line of the cash flow statement is called opening cash, and that's how much cash do I physically have in the bank, under the mattress, wherever I've kept it. What opening cash have I got? And that's physical cash in hand. We say plus money in, minus money out. I told you this was complicated. Gives you what we call closing cash or free cash. The marketers in the room are saying, hey, Grant, finally we're getting somewhere, free cash. Now you're talking. So funny enough, that term free cash was made famous by Warren Buffett. Warren Buffett is that famous investor, the Oracle of Omaha, and he said when he invests in a company, he measures the ability to generate cash as importantly as the ability to generate profit. So you can have profit on paper, but a sale's not a sale till the money's in the bank. So free cash is as important as profit. So what money have you got? Opening cash, plus money in, physical cash money in, minus money out, gives you what we call closing cash or free cash. If you have a look on slide 65, you'll see some places where money comes into the business from. So cash sales, payments from our postpaid customers, interest income, bank loans, VAT refunds. It doesn't matter if it's balance sheet, income statement, if it's physical cash in, it comes under money in, physical cash out, money out. Some places the money goes out to, overheads, expenses, loan payments, supplier or vendor payments, VAT or tax payments, any physical cash in. So the cash flow statement says, at the beginning of the year, what cash did I have? What physical cash came in, minus what cash went out, gives me my closing cash or my free cash. If we were looking at a more complicated statement, it's the same format, but they split it into three. There's cash generated from operations, your day-to-day business, cash generated from financing, have you borrowed or repaid money, and cash from investing, have you issued some share capital. So same document, just split into three, and we're still, in that bottom line, we can see free cash, what cash is available. We say if I've got more cash than I know what to do with, I've got a surplus of cash, and if I've got a shortage of cash, it's never a loss, it's called a deficit. So have a look at those words on slide 68. It's really, really important. So the cash flow statement can never show me a profit or loss. So in a profit and loss, we match the income and the revenue together to work out our profit. On the cash flow, it's pure physical cash in, cash out at that time. It can never show me profit. And that's why if I have an excess of cash, free cash, I say I've got a surplus, I can never use the word profit. Likewise, if I've got a shortage of cash, I've got a deficit. That doesn't mean I've made a loss. And probably a good example is a construction business. So you imagine you're doing a large construction project, I get a draw of, I don't know, X $100 million. I then go and do the work. At some stages I'll have a surplus, lots of free cash. Then I'll go and do the work. I'll have a deficit waiting for my next draw. So it can never show me profit or loss, but I can have a deficit, a shortage, or a surplus. I've got excess cash to what I need.
If I could just touch on that a little bit, like we were saying earlier, sometimes the nice thing of looking at bigger business, bigger corporates versus smaller businesses, sort of small privately owned, let's say SME businesses, is that it's all the same concept, just less or more zeros. And what we find a lot is because not everybody's looking at all three of these documents. A lot of people only look at cash flow. Some people only look at income statements. Some people only look at balance sheet. You get a very different kind of skewed position because, as you see on the cash flow forecast or statement, only things that have a cash equivalent or a cash transaction show. Whereas obviously in an income statement, there's things like depreciation where there's no actual cash or money changing hands. So a good example where we see in a lot of the small, medium-sized business owners, people maybe that might not have a solid financial understanding, might not, like a bigger corporate has got a financial director, whole finance department managing cash. And you'll have an example of a business that's profitable. The business owner might not know how profitable or non-profitable, but often what will happen is halfway through the year, the business owner's accountant will come and see him and say, listen, it's provisional tax season and your business has shown a profit of whatever it might be, and the government wants you to make a provisional tax payment of
30-40% of that,
whatever it might be. So maybe $300,000 or whatever the figure might be, provisional tax. And the business owner will turn to the accountant and say, but hold on, look at my bank balance here. I'm actually in overdraft. There's no cash reserves. Where is this profit? And there you've got a profit and loss account or an income statement showing the profit, but the cash is somewhere else. That's why that business is running in a state of deficit, and actually the cash cycle hasn't caught up with the business. It's about really understanding those two sides of the business and different strategies. You want to improve profit, but often profit strategies can destroy your cash strategies and vice versa. So it's balancing those different things.
Now, Trevor, I was at a talk you did recently where you talked about the cash gap, and I love the way you explained that. Tell us a little bit about that.
I suppose one of the key things, that's a good analogy or a good question there, because people often talk about cash flow problem, and a lot of business owners, a lot of corporates talk about cash flow problems. But a cash flow problem is exactly that. It's a problem. It's a symptom of something deeper. And what's deeper is the cash gap. There's a gap inside the business, which is basically a gap from when it goes out to how fast it comes back in. So generally our cash is sitting in three different places. It's either sitting in our own bank account, it's sitting in our supplier's bank account, four places, our customer's bank account, and very often we forget that it's often sitting in stock, depending on the nature of the business. That's often what we forget that area of stock. So to look at ideas on how do we improve the cash gap is obviously to get better terms from our suppliers and pay them slower, to get reduced terms from our customers, get the money in from them faster. But a key thing as well is our inventory turns, and get our stock out faster, keeping lower inventory, because we forget that whatever it is our product, whether we're selling electronic equipment or furniture, whatever it might be, we've got to keep lower stock levels, because that is cash that could be used for whatever reason that we need it. So understanding the cash gap is a key area.
Yeah, I love the way you explain that. That's brilliant. So there's the cash flow statement for you. So how much cash did you have at the start of the year or the period? What physical cash came in? What cash went out? How much am I left with? Is it a surplus or a deficit? Not a bad thing to show a deficit, as long as you know how you're going to fund it. In our case study, San Luciana, we might fund that cash flow deficit through share equity, so our own investment. We might borrow more money. So that bottom line of the cash flow statement will tell us how much cash flow gap we have, and then we've got to think, how might I fund that? Cool, so nicely done, Trevor. That's great. We should do this professionally. Yeah. So we had a look at three crucial documents. So we looked at the balance sheet. It showed me what money came in, where it was sitting, who gave us money and where did we put it? Did we put it somewhere wisely? We had a look at the income statement, profit and loss, or P&L, which showed me my revenues, my costs, and my profits. We said that bottom line, profit is sanity, turnover is vanity, and it's that bottom line number that's so important. How much profit do we have? What might we declare as a dividend, and what might we reinvest back into the business to grow it the following year? Finally, we looked at the cash flow statement, physical cash in, physical cash out. Are we left with a surplus or a deficit? Each one of those documents tells us a different story about the state or the health of the business. And in our last section, we're going to look at making financial decisions. So we call it ratio analysis or financial analysis. So if you just turn to slide 71, I wanted to introduce something to you called the World Telecom's Financial Benchmarks. So the benchmarks are some financial analysis Informa does of the top today 42 operators in the world. So why might we want to use ratio analysis? And the thing that ratio analysis does is it lets you look at different aspects of a company's health on a level playing field, comparing like for like, apples with apples. So imagine something like AT&T or Verizon and something like Bharti Airtel. So one is huge in terms of revenue size, one is a little bit smaller. It wouldn't be fair to compare them on like for like because they're two totally different businesses, totally different sizes. So ratio analysis lets me compare companies of differing sizes on a level playing field, apples with apples, and that's what ratios do. So on 71, you'll see there's a whole lot of different companies there. We'll do some financial analysis on all of those companies at a group level. So if you buy the Informa full license, you can go and dig down by opco, but we just look at the published free version, which will give you results by group. And you can go and take a look at those and see how they compare against others in the industry. So take a look at that and see who you might be interested in. In Africa, we're probably looking at MTN, Vodacom, Vodafone, Etisalat. Who else there might be interesting to take a look at? And we might also want to take a look at operators there where they've got different models. So you'll see Time Warner is there, that's a media company with telecoms. You also see SoftBank. So SoftBank is a Japanese operator. I like to call them a venture capital business with a mobile phone problem, because they've got enough of an operator network to fit into the telecoms benchmarks, but they're into all sorts of things. So SoftBank owns 14% of Uber. They're in the WeWork IPO. They're in all sorts of other things, and that also leads me to think. The operator, the mobile phone operator of the future, might be a venture capital business with a utility arm that's a phone company. And who knows? I'm sure Alan's had lots of discussions with you on this. So we are going to have a look at those financial ratios, and we'll talk you through them in more detail. And if you have a look at slide 72, it's a really nice summary of those. So what I want you to do now is we're going to pause the video, and if you could open up from the Padlet the World Telecoms Financial Benchmarks. It's Q1 2019. So you'll see that there's a whole lot of historical ones there, so if you want to go back and compare in your own time, you could do it. But the one that we're going to take a look at now is the Telecoms Financial Benchmarks Q1 2019. So Q1 2019. So Alan, if you don't mind pausing the video now, make sure everyone's got the telecoms benchmarks, and then we'll come back to you. Nothing, we'll just carry on. So let's pull it up. Right, you're back. So you found the benchmarks. Well done. We're going to just talk you through them now. So on the cover, you'll see World Telecoms Financial Benchmarks, Q1 2019. You're probably wondering where Q2 is, and there's always a lag. You can imagine in every area of the world, they publish the group results at different timings. So there is a slight lag. If you have a look at the second slide, you'll see that there's a list of operators, and you might decide now who you're interested in taking a look at. Definitely Orange, MTN, Vodacom, Vodafone, Airtel, and there might be many more that you'd like to go and take a look at there. You'll see that there's a lot of detail, which we won't take a look at now, but in each report there's a little bit of technical detail about the industry. So slide 4, slide 5, slide 6 you could take a look at in your own time, and I want you to head to slide 9 and 10 of that report. So 9 and 10 is the World Telecoms Financial Benchmarks, and they've presented the financial ratios in a beautiful way. And if you're not a financial wizard, I'd really encourage you to print out these 2 pages, laminate them, and keep them handy, because they will come in useful to you. So it gives you the financial ratio, the formula that you use to calculate it, the definition, what does it mean, and then also an interpretation, how do you interpret that ratio in a telecoms environment. So we're going to talk you through each one individually, but it's a beautiful summary, slide 9 and 10. I really encourage you to print that out and laminate it and keep it. So then head to slide 12, and it's the industry income statement. And I just wanted to talk to you about what might be interesting to you here. So if I look at the industry income statement, quarter by quarter, the first thing that strikes me in that first line is total revenue. So anyone that says that telecoms is dead and dying, I say no way, Jose. Almost $1.5 trillion of revenue. So we might be stagnating, we might have some issues and some opportunities to innovate, but this industry is not going anywhere. $1.5 trillion worth of revenue there. What's interesting, you'll see there's a growth in revenue, and that's the first time in quite a long time that we've shown an aggressive single-figure revenue growth. For the most part, it's been stagnating. Why have we been stagnating? Probably declining revenues, increased over-the-top competition. It's been really tough to increase revenue. How have we increased revenue? Looking at other services, enterprise, ICT, SME, we'll be looking to all kinds of new segments to generate more revenue. And what's interesting is I think that revenue growth is coming from non-traditional revenue sources. So it's not coming from voice, data, text messages. It's probably coming from operators either acquiring other companies or diversifying and investing in other sectors. And most operators have got a strategy to invest outside of telecoms. Give an example, MTN, largest online music retailer in Africa. MTN did a IPO recently on the New York Stock Exchange, their online shopping platform. So operators are starting to transition from purely communication service provider to all sorts of other offerings. We've got this amazing client base, amazing data. How might we monetize it better? So that's interesting to take a look at. If you have a look at the OPEX line there on slide 12, you'll see OPEX fairly stagnant, and most of you would have been through things like headcount freeze, CapEx reduction, OPEX reduction. It's been a tough time to be in a telco at the moment because we're trying to cut costs and maintain and grow revenues.
Yep.
Yeah. Interesting enough, take a look at the line that says net income margin. Now, net income margin, we're going to look at visually later on, is the sense of every dollar that's left for me after I've paid everybody else. Do you remember Trevor talked us through turnover, revenue, expenses, net profit? So that net income is the net profit that's left for me after I've paid everybody else. And then net income margin is expressing that number as a percentage of revenue. So how crazy is that? In Q1 2019, for all the work that we've done, we're left with 8 cents of every dollar.
Every dollar. Yeah.
So we're enabling everybody else they're claiming most of the profits. And for all that CapEx infrastructure and work that we do, 8 cents of every dollar is the profit that's left for us. So it's a very fine margin. That's not terrible because it's 8% of $1.5 trillion, so it's money. But I definitely feel like we're doing a lot of work, a lot of investment for a very small margin. And obviously the $1 million question, $1 trillion question is how might we grow that?
Yeah.
CapEx as a percentage of revenue is an interesting one. You'll see there CapEx spend quarter by quarter and CapEx as a percentage of revenue. And that's telling us what percentage of every dollar we're investing back into CapEx. Licensing, 5G licensing, 4G and 5G technology. Interesting enough, we'll have a look Q1 2019, just under 16 cents of every dollar going back into CapEx. Crazy, right? It's an expensive business to be a mobile operator. At the peak of 4G rollout, that was 27 cents of every dollar going into CapEx. So almost 30% of our revenue straight back into CapEx rollout and infrastructure. So that's interesting to me because it tells me that we can probably not afford 5G. So we know we have to do it. We want to be first a market leader. We know we need to do it. We know we need to monetize it. But the numbers are saying unless we can significantly monetize 5G profitably, it's going to be too expensive. And that's another $1 trillion question.
Yeah, it's always that, isn't it? You've got to spend money to make money, but how much are you willing to spend the risk versus the return?
Yeah, exactly.
And these are the sort of matrix, though, to look at the different industries like that in advance before getting into them.
Yeah, exactly.
Not learning it too late in hindsight.
And talking about other industries, if we looked at Microsoft, Facebook, Google, they spend anything from 15 to 25% of their revenue on R&D. So what we spend on physical CapEx, they're spending on research, innovation, development. How much do we spend as an industry on innovation? 1% maybe. Depends. All right, let's take a look at the balance sheet. So this is interesting. Have a look at slide 13 of the telecoms benchmarks, Q1 2019, and you'll see that current liabilities outweigh current assets. So current assets, do you remember at the top of the balance sheet was our working capital, stock, cash, and customers? Current liabilities is our short-term debts, the money we owe vendors and short-term bank loans. And our liabilities exceed our assets. So as an industry, technically, we are insolvent. Yeah. So if we were smaller, we'd be bankrupt. Fortunately, as an industry, we've got so much revenue and so much asset base that it's not a terrible... it's a bad place to be, technically insolvent, but not terrible because of our size and strength of asset base. But if you were an investor, you'd be worried because we owe short-term more than what we have. Why is that? We invested into 4G and we haven't been able to monetize those networks. So again, trillion-dollar question is how might we monetize better the infrastructure that we have, grow our revenue, spending as little as possible. So I really encourage you in your case study for San Luciano this week to be creative, do we need to build another network for the island? Do we need to own the network at all? Do we need to be a pure mobile phone operator? All of these questions are linking towards the model that we're currently in, and is that the best model? Could be. You get utility companies that make money, but perhaps you don't want to be a utility alone. And if you don't want to be the utility, how might you structure your business differently? So some questions for you there. You'll see total assets versus total liabilities, $3.5 trillion of assets versus 2.2 trillion of liabilities. So long term, we've got $2 of debt for every $1 of shareholders' equity. Before 4G rollout, it used to be the opposite. So as operators, we had $2 of our own money for every $1 we owed outsiders, and now that's opposite. We owe $2 for every dollar of our own. Again, it is what it is. But we've invested a huge amount of shareholders' money into this CapEx network infrastructure that we haven't yet successfully monetized. Last number that I have a look at over there is number of employees. Quite interesting if you go back 5 years to now and look at the number of employees in the industry. The average telco exec is doing the work of 2 to 3 people because of headcount reduction. So obviously part of that is outsourcing and insourcing, but interesting to take a look at. And you'll see at the bottom there's some notes you can go and have a look at in your own time. So lots more interesting data that we don't have time to look at today because we want to get into your case study. And I want you to head to slide 19. So slide 19 will show you the top 42 operators benchmarked. And the first ratio we're going to look at is total revenue. So Trevor, do you think I should care about being the biggest in the world in terms of revenue?
Come on, everybody, you know the answer. It depends, right?
Yeah, good answer. Nicely done. A friend of ours always says, revenue is vanity and profit is sanity. So it doesn't tell us anything in isolation to have the most revenue in the world, but in the world, AT&T and Verizon, the 2 American operators, the largest revenues in the world, and you can go and take a look at their, interesting enough, in the top 5 or 7, there's 2 companies where mobile phones are not their core business. So Comcast, SoftBank, mobile phone is not their core business, but highest revenues in the world. China Mobile in the top 5, and NTT, which is a Korean operator, is there as well. So that's interesting. If I look at revenue year-on-year growth, so take a look at slide 20, this gives me a little bit more detail because it's telling me how much I've grown. And as an industry, we've grown almost 4% in revenue, which might not sound exciting, but for us, it's huge. We haven't had growth that high for 2 years, so that's amazing. Comcast and AT&T in 2nd and 3rd place, respectively. And interesting, do you see there Zain? Zain is outlying 57% revenue growth. And the reason that they've grown, you'll see there's a note, is that Zain took their Kingdom of Saudi Arabia revenue, which used to be in a separate opco, and they rolled it into Zain Group. So that growth is not it's a temporary growth because of reporting. It's not organic, natural growth. What's interesting to look at in revenue growth is how much currency fluctuations can impact these numbers. So you'll see Turkcell, sometimes the Russian operators, even in Africa, we suffer from our fair share of currency fluctuations. So this is looking at pure revenue growth. It doesn't take into account, it doesn't, you can't really see how currency fluctuations are part of this, but it's interesting to take a look at the growth as an industry.
I'm excited at the next slide because now I'll be able to actually answer your question where you're talking about AT&T, because obviously revenue is one thing. It's always easy to brag about revenue or sales or turnover, but we often see it's not all about turnover. Let's see what the profit is, and now the EBITDA will be able to tell us that. So where AT&T was the biggest, if each of you can look in your own packs there, find AT&T in the profit, where are they sitting in profit standing?
Yeah, so in the bottom 10%. So on slide 21, EBITDA margin, AT&T, you're at a lovely point. Biggest revenue in the world, in the bottom 10 in terms of EBITDA.
Yeah.
So revenue alone doesn't mean success.
And again, it comes back to strategy and revenue versus profit and what are we doing, dividends, etc. What's our long-term strategy? But yeah, there's so many different angles to look at any business.
Yeah, and again, like the 3 documents, you've got to look at all the ratios together to get a true sense of health. You can't just look at one.
Yeah.
Vion, I don't know too much about Vion. It'd be interesting to look at Vion in terms of the what they're doing. Etisalat normally has the highest EBITDA in the world, Etisalat Group. Normally it's Singtel. Singtel's normally in second or third place in terms of EBITDA margin. So as an industry, our EBITDA margin, the percentage of revenue that's left for us after our OPEX is 33%. So again, it's an expensive business to be in. So that's interesting to take a look at there. If I have a look at the next slide, slide 22, it's net income margin. Again, percentage of revenue that's left for us after we've paid for all our costs is the money that's left for us, 7.9%, 8 cents for every dollar. Vion and Turkcell, highest operating margin in the world. STC, Etisalat and Vodacom in 5th place. Vodacom is an interesting one. So Vodacom is part of the Vodafone group, but reported separately because their operating model is so different. So Vodacom is 11 African countries, operating with some 4G, but mainly 3G to deliver their network. So their capex cost is much lower, their efficiencies are much greater than Vodafone Group. So that's an interesting one to look at in terms of asset sweating, maximizing profitability. Let's see there. Interesting enough, Vodafone, very low income margin, and SoftBank, a massive loss. So all well and good, been invested into tech stocks, but high risk.
Does it deliver?
I wonder if that's Uber that's caused them to have a loss. We'll have to go and have a look. So net income margin, interesting to have a look at. Next one, capex as a percentage of sales or revenue. As an industry, 16 cents of every dollar going back into capex. In the world, take a look there on slide 23. Hutchison, more than 30 cents of every dollar going back into capex. Bharti Airtel doing a massive 4G, 5G expansion in India. Axiata and Turkcell, likewise huge investments. And you'll see straight after there, China Mobile, China Unicom, and China Telecom in 5th, 6th, and 7th place. Now, in previous quarters, the Chinese operators would have been in the top 5 in terms of massive capex rollout to cover a huge area, a huge population.
Yeah.
So that's interesting to see. And then take a look at Zain and STC, very little capex output. And they're obviously reducing their capex spend, maximize profitability, perhaps to increase dividends or to reinvest into other areas of the world. So again, really interesting question. Can we afford 5G, and how might we monetize 5G better? Because our capex is expensive. It's a really expensive cost.
Yeah.
The next one to take a look at, slide 24, is operating free cash flow as a percentage of revenue. And that's the percentage of each dollar that we can turn back into cash. And remember, sales not a sale till the money's in the bank. We want to turn this back into cash. Some of the most successful companies in the world are generating up to 40% of revenue back into cash. Top in the world, Vion, STC, Etisalat, and Zain are really good at monetizing that network, turning that back into hard cash. And cash gives me freedom. I can invest into other things, expand, and grow. The next one is working...
And pay dividends.
Yeah, very important. The next one is working capital. So working capital is my current assets, working capital compared to current liabilities. An accountant will tell you that you would like to have $2 of your own money for every $1 you owe vendors. You'll see on slide 25, the very best operators have $1.80 for every dollar that they own. The average is low. So most operators, 2/3 of the industry, owe vendors more than they have in working capital. Technically insolvent, some liquidity issues. And that's really a sign that's showing us We have to find a way to monetize our infrastructure better, turn that into cash to settle our vendors. So I suspect there was a lot of vendor finance that we haven't yet been able to repay with monetization of network. And again, not terrible because of the size of our asset base, but some work to do. So that's interesting there. Total assets. Again, total assets doesn't tell us necessarily success, but interesting to take a look at on slide 26. And you'll see AT&T, the highest asset base in the world. I'm told, Trevor, that that's because they owned all the American telegraph operators way back when in the Wild West.
It's a legacy infrastructure.
Legacy
that's
property. Yes, they have the
sheet.
property around the telegraph office, and that's how. And again, just also a massive, massive market.
Yeah, geography-wise and population-wise, yeah.
So for many years, Verizon was in second place, and isn't that interesting? In second place now with the highest assets, SoftBank, Verizon in third place, Comcast in fourth place, and China Mobile in fifth place. So it's non-core mobile operators that are moving into the highest asset base, and then huge Chinese and American markets there. But again, total assets doesn't tell us success, just tells us size of assets. Return on investment is an interesting one on slide 27. So return on investment is my return on assets. So if I were to sell up those assets, put that money into the bank, what return might I expect? So Trevor, what return would you be expecting if you invested your hard-earned money in the bank?
I don't know if any of these would be able to deliver. Do you mean in the dream, in my perfect world?
Yeah,
or in reality?
in your perfect world.
Okay.
Yeah, like 8%, 10% return,
yeah.
right?
I mean, the rule of thumb, people always say, well, if you just took your money and put it in a sort of fixed investment fund or what have you, what could you be doing just putting your money away without having to actually do the hard work involved in running your business?
Exactly. Yeah, sell everything and lie on the beach.
Yeah. But yeah, 8 to 10 as a minimum is generally considered a decent return. Obviously, depending on anything upwards, depending on the expected return where you're investing.
Totally, and it depends. In Europe, UK, 3% might be good enough. In other areas, 8% minimum. As an industry, we're less than 1% return. So we're stable. We always give 1% return, but room for improvement, we could say, maybe, right? Yeah. So that's return on assets. We then have asset turnover on slide 28. So asset turnover is the percentage of assets we turned into revenue, and that's how are we monetizing our capex. You'll see, interesting enough, the two top operators at monetizing their capex are Korean, followed in third place by America Mobile, fourth place MTN. So we're really good at taking that asset base and monetizing it in terms of turning it into revenue. And that's the $1 trillion problem we have, is how might we monetize our capex better. On slide 29, you'll see net debt divided by EBITDA, and that's telling you how many years of EBITDA it would take you to pay off your debt. You'll see, nice if you're Etisalat, China Mobile, China Unicom, or STC, you've got very low debt, so less than 1 year of EBITDA to pay off all your debts, so quite a strong position. At the other end of the spectrum on slide 29, you'll see Tele2 and Bharti Airtel, 3.5, 4 years of EBITDA to pay off your debt. So they've obviously funded their capex with borrowings. Not good or bad, it depends, but a lot of borrowing to roll out that capex. Industry average 2 years of EBITDA to settle your debt. The next one is financial leverage. So slide 30, that's total assets divided by shareholders' equity. And that'll tell you how many dollars of assets for every dollar of shareholders' equity, shareholders' funds. So if you're a shareholder, it's essentially telling you how many dollars of assets your shareholder funds are secured over. So again, as an industry, we've got this huge asset base, so it's fairly secure. Even though short term we have some cash flow challenges, we've got this huge asset base giving us security. So roughly $2 or $3 of assets for every $1 of shareholders' equity. And that's why I guess telco shares are a blue chip investment, very stable, lots of assets, small return, but it's small, consistent return. And our challenge is to grow that. Return on equity, so do you remember that slide on return on investment, which was our profit divided by assets? This is similar. So on slide 31, that's our profit divided by our shareholders' equity. So that's as a shareholder, for the money you as a shareholder have investment, what return are you getting? 2.4%. So in some parts of the world, 2.4% would be enough. You probably want 8 to 10%, Trevor. Yeah. More. See where you're going.
You're asking about what we're going to be investing in, so
Yeah.
yeah.
Might not be telco. Oh, no, portion of assets into telco, but 2.4% room for improvement, I guess, right? So those are the numbers presented in the form of financial ratios, and I love that visual representation where you can see the groups pictured visually. A picture really does tell you 1,000 stories. So hopefully that's enjoyable for you and interesting. There's lots more you can take a look at. So in your own time, you can go and have a look at revenue growth, mapped out, net income growth versus OPEX, and there's lots more detail there. And we publish these every quarter. So if you come back to the Padlet, the new ones will always be uploaded there for you to take and use. So we hope this recording's been useful to you. And we're going to stop the recording now, and then Alan will play a recording of how to use the spreadsheet. So we've created a financial modeling tool for you now. So you'll be able to take the financial skills that you've learned and start to model out your strategy for the island. And we've pre-recorded that already, so you'll be able to play that, download an Excel tool from the Padlet, and then start to think about the financial decisions that you need to take to build your model. And we've done a separate video previously that'll tell you how to drive that spreadsheet. So from Trevor and I, we'll see you tomorrow for leadership. And a question
We'll
and
see you
answer.
shortly, actually,
Yeah,
for our Q&A once you
Yeah.
finish the session.
True
So I'll
that,
see you
true
soon.
that.
Yeah.
Cool, thanks guys.
Cheers.